Let me ask you a question. What if I told you there's a way ordinary people, people just like us, have been quietly building real wealth for decades? We're not talking about some overnight crypto scheme or some crazy hype train, just a proven, steady approach. Would you believe me?
A lot of people think it's got to be one of those two things. But honestly, it's really not. What's going on, finance lovers? It's Josh here with JoshLM Finance, and welcome to another explainer. Today, we are going to cut right through all that noise and break this down super simple without any of the stress or confusion. All right, let's dive right in. First things first, what is investing? Really? Let's forget all the complicated jargon and hype you see online. We're just going to look at the simple truth so you have a foundation you can actually build on.
At its absolute core, investing is just putting your money into things, assets, that have the potential to grow. But here's the secret ingredient, the one thing that matters most. Time. Yeah, this isn't about getting rich quick. It's about letting time and consistency do all the heavy lifting for you.
Now, look at this number, 10%. Over the long haul, that has been the average yearly return of the U.S. stock market. And average is the most important word there. Of course, some years are down, some years are way up, but when you zoom out and look at the big picture, across decades, that long-term trend is what has consistently built serious wealth.
Okay, so how do you actually do this? Well, most people who are just starting out use two main tools: individual stocks and something called an ETF. Let's break down what they are and, what the real difference is.
First up, a stock. Buying a stock is actually pretty simple. It just means you're buying a tiny, tiny little piece of a real company. You become a part owner. So if that company does well and grows, your little piece becomes more valuable. Oh, and sometimes companies will even pay you a little cash. That's called a dividend, just for being an owner. So when you buy a stock, you're essentially placing a bet. You're saying, I believe in this one company and its future. But here's the catch, right? Putting all your eggs in one basket is, well, it's risky. Some companies do incredibly well, but others can, totally fizzle out. And that's exactly where our next tool comes in. And I love this analogy because it makes it so clear. Think about it like this. Buying a single stock is like betting on just one star player. They might be amazing, but what if they have a bad game? Buying an ETF, which stands for Exchange Traded Fund, is like owning the entire team. Instead of putting all your hopes on one company, you're buying a whole collection of them all at once. And this is exactly why beginners, and honestly, a lot of pros, love ETFs. You get instant diversification, that's just a fancy word for not putting all your eggs in one basket. That immediately lowers your risk compared to picking single stocks. The fees are usually super low, and, well, they're simple and kind of boring. And trust me on this one, in the world of long-term investing, boring is an absolutely fantastic thing. So, we've got the tools, stocks and ETFs. But what's the engine that really makes this all work over time? Let's talk about the one concept that's so powerful it almost feels like magic. And it's called compounding. It sounds complicated, but it's not. It's simply when the money your investments make starts making its own money. It's like a snowball rolling down a hill. It starts out small, but as it rolls, it picks up more snow, getting bigger and bigger, faster and faster, all on its own. And this right here shows you everything. A small amount of money invested regularly, consistently, is way more powerful than trying to make these big, emotional moves based on fear or hype. The people who win at this long term aren't the geniuses trying to time the market perfectly. Nope. They're just the ones who stay consistent and stay in the game, letting that compounding magic do its work through all the ups and downs. Okay, before we get too excited, it's super important we pause for a second and do a quick reality check. Because when we're talking about your money, context is everything. So first, and this is important, please remember everything we talk about here is for educational purposes. This is not financial advice. Everybody's situation is different, so you should always think about your own circumstances, and maybe even chat with a professional. And remember, the market will go up and down. That's just what it does. It's part of the game. That's why your personal timeline is so important. For example, if you need this money next year to buy a car, the stock market is probably not the right place for it. But if your goal is retirement in 10, 20, or 30 years, well, that's the kind of long-term time frame where investing really gets to shine. All right, let's wrap this all up. If you only remember one single thing from this entire explainer, I want it to be what's on this next slide. This is your core takeaway. This is the simple stuff that actually matters. Let's call this the beginner's mantra. 1. Stocks equal ownership in one company. 2.
ETFs give you that diversified, beginner-friendly exposure to a whole bunch of companies. And 3, the most important one, time plus consistency is always going to beat hype and trying to get rich quick.
So, there you have it. If this helped clear things up for you, if a little light bulb went on, do me a quick favor and hit that like and subscribe button. Seriously, the whole mission here at JoshLM Finance is to keep breaking down these money topics just like this, simply and without all the fear. And I've got a question for you. What do you want to break down next? For real, if you want to follow up where I show you exactly how to open an account and buy your very first ETF, step by step, just let me know down in the comments. Your feedback is what actually drives this whole channel. Thank you for watching till the end. If this video helped you, you know what to do. See you in the next one. Take care.